Hey everybody, Preston Brent here. This is going to be our 2018 year-end roundup. I hope everybody had a really good end of year kickoff to the new year. I took off about a week or so, and wouldn't you know, when I take off, the markets just get very frothy. Not that they haven't been frothy already. Just a couple of points I wanted to make here. It's really interesting at the end of the year, everybody kind of takes a snapshot of the way the year went, and then you see all the resolutions and the wishes for the new year. But I've always felt wishes in the market are like the special novelty of rat brain traders. We're not wishing for anything. We're going to react to what the markets give us. We've always done that, and we're doing that going forward. The trades and the strategies that we're running are deceptively complex, but very simple to manage and run. And it allows us to make money in a rising volatility market or a falling volatility market. We've seen our trades over the past fourth quarter do well. So for those of you that are not members, I highly encourage you to come in and join us. We've had a pretty large group of folks coming in and joining us at the end of the year. Love to see some of you folks come on in, more folks come in. But anyway, let's kind of get into the 2018 year-end roundup here. One of the things I noted in 2018 at the beginning of the year, I said it's probably not going to be like 2017. 2017, we had realized our historical volatility at the end of the year of about 6.8%. That set a record, folks. The markets tend to be mean reverting, so I said the odds favor volatility coming back. And at the end of the year, I didn't know how right that statement would be, but at the end of the year, the realized volatility for 2018 came in at 17%. That's 150% increase in the historical volatility. That's the actual movement of the market in 2018 versus 2017. I mean, really huge. And if you look at what everybody thought would happen at the beginning of 2018, meaning interest rates would go higher, and the dollar would change, bonds would fall precipitously. None of that really came true, and the stocks that people thought would do very well, and the ones that everybody thought would hit $1 trillion in valuation, one of them touched it and then just gave it all up, and we haven't seen it since. So 2018. It was a really interesting year. Again, our strategies are working out really well. We call it the rolling thunder strategy. And 2019 promises to be another really good year for our go forward where we do it. But there were many surprises in 2018. Besides the volatility, you know, the way we started off the year, I don't want to go through quarter by quarter because everybody knows what happened during the year. Okay, I mean, that just is a waste of time in my mind. But some of the things that we can take note of that we can use in 2019, we're going to see a lot more risk off type of environment in 2019 versus 2018. There's going to be obviously higher volatility. We're above the historical norm right now going into 2019 with a realized volatility on average of around 17%. But we're going to see return of capital taking on more of a priority than return on capital. And in our option masters, I go through a lot of detail on risk management and the little known, very seldom covered topic of position sizing. And that's something I would highly encourage you folks to check it out. It's something that I think would help you out dramatically. This fourth quarter, we set a lot of records, folks. I mean, we saw the worst December, I think, since going back to 1931. We saw the Dow move more than 1,000 points to the upside, probably more of a short squeeze than anything else. We've seen about $4 trillion in value come out of the U.S. market. That's roughly about 20% of the GDP, just wiped out. It really amazing. We've also had a frenzy with hedge funds and mutual fund redemptions, people taking money out. Most people tend to take money out at the bottoms rather than the tops. We've seen some fund rebalancing by pension funds, tax loss selling, that all added to the downward spiral that we had in Q4. Okay. So one thing that the bulls, I guess, can maybe hold on to is these past two decades, the compounded growth, I saw this out of Barron's. I thought I'd just relay it to you guys. The compounded growth in the S&P, or the Dow rather, over the past 20 years was, I think, what it come in like 5.6%. Now, the average going all the way back to 1928 is 10.7%. So that would suggest markets long term are mean reverting. But what does that mean for us? Not much for 1 year. I mean, I've always said day to day, the markets are a voting machine. It can go up, it can go down. Throw in volatility, a little bit limited liquidity. With our members, I go through in enormous detail the quantitative tightening and what that means and how it comes off the Fed balance sheet, and how it can affect the credit markets, the bond market, the corporate debt market, all of these things, whether you trade it or not. You've got to understand it because it will come in and kind of whip equities around a pretty good little bit. And, in 2019, we've got plenty of worries to take a look at. We've got the global growth story, which is kind of coming in a little bit more anemic than feared for 2019. Remember, 2017 was the year of synchronized global growth. Remember that coming out of the TV talking heads? And now we've got 2019, just the opposite. So how can things change so fast, so quickly? Well, I've said this many, many times, and I know my members understand what I'm saying here, that when we have a decade of zero interest rates, or in many cases below zero interest rates, at one point there was $4 trillion in government debt that was below zero interest rate, right? Amazing. That's where you're paying them to hold your money. I mean, just insane. So we've had essentially zero interest rates, so cheap capital. And cheap capital for that long a period has consequences. It tends to inflate assets all across the board. It also tends to cause corporations to do a lot of corporate buybacks. We've had corporate buyback has amounted to about a third of the total earnings per share growth since 2011. I mean, that's how strong corporate buybacks have been, but why shouldn't they? I mean, you've got almost zero cost of capital. So it's a great way to increase earnings per share, just by doing that, right? Just by buying back your stock. So we've seen that inflate or continue to inflate earnings per share. So what's the real growth rate? I mean, it's kind of like that statement, at the end of a horse race, who won the race, the horse or the jockey? Where is the true growth rate of corporations? This is all over a longer period of time going to settle in. So I've been telling our members over fourth quarter, even though markets have been pulling back, they're trying to find a valuation, a fair valuation in the markets that makes sense. At some point, buyers are going to start to step in. Now, the PE ratio right now, as of this Friday's close, is right at about 12-month PE ratios, right around 16.01. And that's about off 25.8% from this time last year, right? Or essentially the end of 2017. So 25 to 27% less. So valuations have dramatically come in. Surprisingly, almost the same amount as the corporate buybacks have added to the earnings growth. So we're going to see some dynamics and shifts take place in 2019. And generally, I have found that when you look at the forward year and you see what everybody thinks is going to happen, 9 times out of 10, it's rare breed that you can find someone that's consistent year in and year out. So you've got to discount that. You've got to follow price action. You've got to follow key pivot points. You've got to see where volume is supporting price and when it's not. All of that just plays perfectly for our rolling thunder strategies that we're running right now. And we're still in a bearish mindset. Our bear market trading still rules. Our dragons are running fine, which is what we call our rolling thunder strategies, dragons that we're running. And whether volatility goes up or goes down, our dragon strategies are easy to play with and adjust and manipulate so that we can make our returns that we need to make. So this is kind of what I'm looking at as we end 2018 going into 2019. Clearly, there's a lot of worries and issues that I've talked about. There's some I haven't talked about. I mean, we can have policy mistakes by the Feds, but the markets reacted positively to Power Ranger Powell when he was there with Helicopter Ben and Aunt B Yellen, Janet Yellen on Friday, and they all kind of agreed with each other on their thesis. So they're still the puppet masters, and the markets are still the attached to them where they go. So at some point, though, we're going to get more repercussions from the central banks. We've got Super Mario Draghi in Europe still in a pickle. Europe is slowing down, and he's talking about doing the same thing that Jerome Powell started to do this November, about a year ago, a little over 13 months ago, 14 months ago, when he started very slowly pulling down our balance sheet and our quantitative tightening. Now, Super Mario wants to do that in Europe, but their economy's worse than ours. So I just don't see how he can do it. I don't see how they can raise rates. Now, the markets are pricing in. The bond market has forced Jerome Powell's hand. They forced him to come out and do this statement Friday. And the markets liked it. It moved up, 80 plus points. The Dow up 700 plus points. But again, I just kind of take that with a grain of salt. All right, we're going to be in for some of this until we get a couple of key things settled in. One, we get the resolution of the China-U.S. trade tariffs. We saw the Institute of Manufacturing. The manufacturing data came in very poor. But I think we're going to settle in. We've been over 50 for the past 28 months, which is an expansion in the manufacturing. So I don't see a recession next year, guys. Personally, and it doesn't really matter what I believe personally, but I do believe that the markets are going to have, we'll see volatility start to settle in, but probably not through until we get through the forward guidance of the corporate earnings in Q1, which is going to kick off next week. And then officially the week after, I guess, we don't have Alcoa anymore, leading the way officially for the beginning of opening corporate season. We generally get the banks on a Thursday or Friday, week after next. Towards the end of the month, we get the FOMC. We're going to get the meeting minutes from their December meeting, but that's already changed from what Jerome Powell said this past Friday. So we got a lot of these things coming up. I also want to see the budget crisis in Italy kind of go away. Another little ticker hiding out there is the Brexit and whether they're going to separate the end of March. That's when they're supposed to. So we've got plenty of things to put on our checklist to possibly increase and jam up volatility. So do not get giddy, as I'm telling our members, in any of these moves higher. We can just as easily have had a down day of 50, 60, 70 E-mini handles as well, or the Dow down 600 or 700 points. So we're going to watch this very closely. Let me get to the charts here. I'm just going to do a brief overview of some of the major indexes here, and then we'll kind of I'll take it from there, and then we'll pick up next week with our weekly reviews. You can see here the Dow or the S&P basically for the year was down about 6.2%. Okay, and you can see we've opened. And we're slightly higher from where we closed on 2018. You can see the 2019 low here and then the 2018 low, which was driven, the 2018 low for the year came in the day after Christmas. All right, when we had that sell-off and then that big, huge run higher in all indexes. I mean, just huge run. I think that was the E-minis were up over 100 and some odd points for the day. So you can see where we're sitting right now. If you look at my chart, if I kind of step it out, my volume over price, I'm using a market map here, which basically projects where the value area is, and it shows the value area around 2743. And if I come out to a weekly chart, all right, you'll see as it paints the value area on here, you can see there are a number of value areas weekly where we've kind of held up right here. The lower one is down just north of the 2018 low, around 2365, right down here. And then there's another value area here, right at our 2019 low, that we made on that big down move, and then we kind of recaptured it, okay, which was the first, I guess it was down here on, what was it? Let me go back to the weekly chart, or daily chart rather, so that you can see it here. You can see here on the area here where we had the 2018 low and then the 2019 low right in that area there. So our 2019 low is at 2438. But going back to the weekly chart, let me just step back for just one moment here. You can see on the weekly chart, this is the pre-Brexit vote right here. This is the overnight Trump election lows right here, 2028, and then the post-Brexit vote right here. All of these are kind of grouped right around the 1950 to the 2150 area, about a 200-point range down there. Um, and there's a debate on whether the markets want to give it up and come right back down there and just kind of do a recalibration. If Trump is smart, and he puts duct tape on the folks in his administration and just kind of sticks to the knitting and gets something done with China, then I think we're going to move back up near this prior pivot high right in this area here around the 2800, a little bit over 2800. If he doesn't do that, then any move higher in my mind is basically going to be a setup for a move lower. Okay. I do believe there's going to be a ton of overhead resistance once we get over 2600. You'll see buyers start to step back in again and try to push it back down below the 2018 low of 2016.75. Probably taking it back down into the 2200s. So that's kind of longer term what I'm looking at near term. Now that can all change. And of course, the one man that can change it very quickly would be Super Mario, not Super Mario Draghi. He's in Europe. Power Ranger Powell here, our Fed chair. All he's got to do is keep that dovish stance, and you'll see the markets move up. But that's just going to set up for a bigger humdinger of a move lower. Okay. So net, we are still playing the markets like they are in a bearish frame of mind. All right, just keep that in mind. Any move higher should be, if you got caught on the wrong side of the move, you should be willing to adjust your portfolio and take advantage of any up moves until we can start taking care of prior pivot highs. You can see the 50 crossing the 200 here. So everything that I show on my chart is basically pointing to any rally here is suspect. Okay. If we look at volume, you can see here that on this big move lower, you can see the volume climbing up here. I've got this purple line, which is a 5 EMA of my daily volume. And then the blue line is a 20 EMA. So 1 week over 1 month. And you can see here with this big move lower that we had tremendous increase in volume. And then we kind of peaked right here, almost like a capitulation moment going into the end of the year. And then you can see volume falling off dramatically as we moved up. I suspect a lot of this move up was kind of a short squeeze. Not a lot of new money coming in here, although there's probably some repositioning, some tax loss selling, other things like that. So I tend to discount the last week of the year, the first week of the new year, and just kind of let things settle in. And then once things settle in, we kind of get a little bit more of a clear picture of where the directional bias wants to move. Okay. But again, Power Ranger Powell is going to be primarily responsible for some of the near-term action. Now, if we look at the Dow, let's look at the Dow futures here. The Dow for the year was off about 5.6%. All right. So again, we haven't seen a negative return year, for 6, 7, 8 years. It's been a while. You can see right now the Dow is just slightly above the 2018 closing price, but not by much. You can see the 2019 low. Again, same thing here. You can see the volume. You can see the volume increasing as we sold off, and then volume coming down pretty quickly as we got this rise up here. So until we get movement up supported by increasing volume, then I'm just not going to get too excited about this. In fact, what I will do is probably make the assumption that the higher we get up in this shaded zone up here, which is a strong resistance zone, we're probably going to roll back over. Again, the 50 crossing the 200 to the downside. So any movement typically in a bear market, even though we're not down officially 20%, any move down like this or any move up to the 50 or the 200, generally that's where sellers start to come back in again. Okay. So if we run up here and we start to sell off, we're going to be looking at some short positions here just to see how far they're willing to run. Okay. So that's the Dow. And then if we look at NASDAQ, I'm going to look at the NASDAQ futures. It's 100 of the largest companies in NASDAQ. But the NASDAQ was off 3.9% for the year. Okay. You can see the NASDAQ is up over the 2018 closing price. So we're slightly up for the year as we kick into the first week. But again, you can see the 50 EMA and the 200 EMA closed down. We got a value area up here around 68.13. So that's going to provide a lot of resistance for us. I don't see, to be honest with you, and the same thing with volume. You can see we did have some good volume coming in today. I mean, or Friday. See that green bar? I mean, that is a good sign for NASDAQ. Remember, NASDAQ has led the markets for the past 3 years, 3 or 4 years, the FANG stocks. So now the question is, are FANGs going to assume the leadership mantle again in 2019? Or are we going to see a shift more to value stocks, meaning more risk off sectors like staples and things like that, and the higher beta growth type sectors like cyclicals or like technology stands aside? I still think we got some more oomph left in the markets, if that makes some sense. But we're going to follow the price action again. Even with NASDAQ, I'm going to anticipate if we get up in this area up here around the 50 EMA or 200 EMA, that sellers are going to want to step back in. So we're going to be watching that fairly closely. Okay. And then, of course, the Russell. I mean, the Russell has really been hurt. This was the first one to run into full-blown bear market territory. All right. You can see from the highs here at 1746. I mean, we're down now 1381, right? And that's where we are right now. So you can take 1746 minus 1381 and then just kind of do the math, and you can see we're down, right around 21% or so, even with this move here. So we're still in bear market territory. You can see the 50 and the 200 cross. We've got this wide separation. Generally, when you get something this wide, we look for a bounce, but that bounce is going to take us right back up to that 50 EMA, and then I'll look for a rollover again. Very rarely do we get a V bottom where it comes down and then it just explodes higher. The bottoming is kind of a process here. And I don't know yet if the bottom is in, to be honest, with the Russell, the Dow, NASDAQ, the S&P 500. I just don't know if a bottom's in yet. But I think we're due for a little bit of a rally. But I'm looking for sellers to step in. So we still have to be very, very careful here. And of course, if we look at volatility, you can see here on vol, if we look at the back month volatility here, you can see in the back month right here, we're sitting right at about, I haven't colored the chart, we're sitting at about a 0.70. So that means we're in a backwardation of the back month volatility, right? If we look at the front month skew, again, I haven't colored the chart yet, but you can see the skew, and we're sitting right now at about a minus 5.8. So that means we're in a contango. So what does that mean when the front month vol structure or skew is in contango and the back month is in backwardation? That means the fear is still out there for February. All right. A lot of fear out there. The current VIX and the January, which is going to expire in a couple of weeks, we're in a contango. But the difference between the January and February volatility skew is in a backwardation. So the markets have built in this fear going out to, in fact, March, because we still have a backwardation in February and March as well. And we've got a number of things that are going to hit in Q1. That is the date when Trump is either going to draw the line in the sand or make progress with China. That's the end of the date when we get the Brexit or we see what's happening there. And we also get the FOMC, whether they're going to hike again or not, and we get corporate earnings. So those four things right there are enough to really, if you're on the wrong side of the trade, you can get hurt. So you've got to make sure that you're hedged. For our members, we'll look at doing our FUBAR trades, which are really great for hedging, especially using the SPYs. So that's kind of where I'm looking at from a volatility perspective. Those skews help us out a good deal. Of course, if we look at treasuries here, everybody thought interest rates were going higher. And what did they do? They went lower. Remember, when bonds go higher, interest rates go lower. This is a daily chart, folks, going all the way back to the beginning of October, when the markets really started cratering. Look at what interest rates did. The bond market said not so fast. We do not see interest rates. We do not see 2 rate hikes next year. In fact, we don't see any rate hikes. In fact, we may even see a rate cut in 2019 this year. So that's the bond market. And if we look at the interest rates on the 10-year, look at this, folks. We've broken key levels here. You can see this key level right in this area here that we broke. And if I just kind of outline it right there, we've come down below this key level. And we're well down here. I mean, the 10-year closed at 2.65, the interest rates. That is a huge sell-off. This is the market saying we don't see rate hikes next year. We don't see inflation. We don't see Powell doing what Powell's got to do. And that's off of a high, an interest rate high of 2018 of 3.24%. I mean, you're looking at 70 basis points on a 10-year interest rate being cut. I mean, that's amazing, folks. So the bond market is still really throwing its fit there and forcing the Fed's hand. All right. So I wanted to point that out. So the markets, even though we have these big moves higher, you've got to be very careful here. Okay. Currency wise, I'm going to watch the euro because the euro is going to really drive the dollar. The euro is about 58, 59% of the dollar index value. And it's having you can see this value area sitting here right around $1.14. If Brexit starts having some issues, then I can see this thing going much lower. All right. I can just see this going lower. I can also see the pound going lower. Now, surprisingly, the pound has been very strong because there's positive news, but look at this. The pound is still down dramatically. All right. So we're looking at the pound and we're looking at the euro in Q1. These are going to be really interesting trades for us. And I think there's going to be some opportunities in them. Okay. Now, if we look at gold, I pointed this out to you guys for the past month. All right. Let me put it on a weekly chart. And our traders are jumping on it. We've been jumping on it. Right. Here's the trade right here. I mean, if you look at the trade, if you guys remember what I was talking about with gold was if you look at this pattern, we've got that. I mean, it's like, I don't know, it's kind of perfect, right? Everybody recognizes that pattern. You should. It's here's the cup and here's the handle right here, a cup and handle. And then, the break generally above this area here, or, and it can have a low handle. It doesn't have to be up here. I could have drawn it where the cup comes back like that. And then the break is generally about a plus 10% move higher, right? That's kind of what we're looking for. But I started saying back in this area right here, selling puts underneath the gold futures makes sense, or GLD, or if you want to be a little bit more aggressive, GDX, which is the gold miners. So and the reason why it just looks appetizing to me is because the markets are really having some difficult times. Now, this is a weekly chart, so everything's kind of bunched up, but you can see all the overhead pressure up here. If I put it back on a daily, just to kind of get a little bit closer in, you can see here, if I move down, you can see the, let's get this thing set here. So you can see the 2017, 2018, 2016, 17, 18 high prices, all in the 1300s. All right, you can see the 2018 open price. I left that on the chart, and it's serving as a little bit of a resistance because we got stuck up in this area before. You can see right in this area here, we got stuck for a long time, over a month. So I'm looking for maybe the handle part of that cup, right? Maybe come back down, and if we get a little bit of support here and start moving up, that would be a good entry point. All right, I wouldn't chase it up at this level. If we have a run into earnings and we have a stronger than expected January with a loose white dove, as I call them, Fed, then we could get an exaggerated handle on this pattern here. But make no mistake about it. Down in this area here, I was saying let's do bull put spreads or selling puts or put credit spreads underneath the market, or doing some bull call spreads as well, because I saw gold as moving higher. Okay, so that was a little bit about the metals side. And then, of course, if we come into energy, we had some members really kick it strong in energy. I mean, if you guys remember, those of you that listen to me on these weekly roundups all the time, back in this area right here, right up in this area here. In fact, I said it before. It moved up another $2 or $3, but I said gold. I said oil is going to come back down to the low 60s. And that was the way we played it. But it overshot the low 60s and just kept right on going down. In fact, I haven't even looked at this chart because I was using another chart. But you can see here the 2018 low was right at 42.36 off the 2018 high of 76.90. And now we're getting a little bit of a bounce here. We've got some divergence here, so it's a good bud play to play it long. But we had members here getting short, making 20, 30,000 a contract, because I was talking about this. If you guys remember, this is when Goldman Sachs was saying oil is going to go up to $100 a barrel. Everybody and their uncle that was an analyst in the energy markets, and they got caught flat-footed. And I was one of the lone doves out there, or hawks out there, saying that gold is not going to do it. There is no friggin' way gold is gonna make that kind of. Oil is going to make that kind of move. Just no way. So that's what we got, and that's where it moved to. So now where to from here? I do believe it's got a little bit of a run in here. We're getting some word out of OPEC, but I think it's going to run into resistance up here in the low 50s. And once it does that, I think the odds favor a little bit of a pullback. We still need to get a little bit more of a firmer low, so I think it'll be one of these sell the rally kind of things. Oil moves up here to the low 50s, runs into the resistance. If it makes it that high, come back down, take out the 2018 lows, making 2019 lows, consolidate for a bit, and then start a little bit slower grind. All right, because remember, the initial move lower in oil was more about the oversupply versus the demand. Now it accelerated because of the lack of global growth, and it turned into a growth story, global growth story versus a supply demand issue, and that kind of accelerated the move lower. So that's where we're sitting there. Nat gas, we made great money in this one too. We traded this explosion higher. You can see this big move higher here in nat gas, and then it formed a pattern, and then we traded the pattern. All right, you guys can see here. If I let me just kind of draw this thing like that. It's not having trouble drawing this morning, but you can see the pattern, right? Like that. Now, typically when you get a pattern like that and it approaches it from the upside, that generally means the breakout is to the upside. Now, I didn't know which way it was going to break out, but I said if it breaks down, it's going for a ride. And it broke down, and I said the odds favor a breakdown. Remember, this was when the Farmer's Almanac and the weather forecasters, everybody and their uncle was saying we're going to have a solar winter. It's going to be very cold. And then they got caught with supply demand issues. Hedge funds went out of business when this thing we've been down here forever. And then it just moved. I haven't seen a move like this in nat gas in years. And once it did that, our radar came up. I said, we got to play it. And the odds favor to move to the downside. And that's what it did. And it came right back down to this value area down here. Okay. So for a lot of our traders, we were in the trade for about a month. And we had fun with it. So any of these imbalances in the commodity market, whether you trade the commodity or you trade the ETF UNG, those worked out really nice for us. Okay. And then we've got some others down here, agriculture, meats. I think meats is going to be one of these that is going to be real interesting story for 2019. You can see here the cattle futures. I think it's going to probably settle in here and then move a little bit higher. If I put it on a weekly chart, for those of you that like commodities and are interested in them, you can see how cattle futures have moved up a pretty good bit from the summer months. I think it's going to move up and challenge this area, and should it break out over this 127.5, it's going to come back up here to about a 135 area. And if you don't want to trade the futures, you can trade cow, of which the ETF cow, about 60% of it, 65% is related to meat, and maybe 20, 30% is related to hogs, lean hogs. But I see this as an interesting play. There are others that are surfacing out there for us, but I wanted to give you guys a quick update. I'm happy to be back. You guys will hear from me now every week until we decide to take another week off, typically at the end of the year or around major holidays. But otherwise, have a really great weekend. Members, I will see you this Sunday night for our weekly market watch. If you're not a member, I highly encourage you to come in and check us out. Check out our Rolling Thunder and our Dragon strategies. They're working great. All right, everybody, have a great weekend. Take care, folks. Ciao.